Welcome to the Party Daily, the show where we keep you informed on the latest trends in the multifamily space. So I'm your host, Roderick Jones, and I'm excited that you're joining me on another episode. And so basically, if this is your first time tuning into the show, this is our daily show where we go over the latest trends happening in the multifamily space. So we keep it up to date on current events. This can be anything from the Fed update, from new deals that's happening in the marketplace, all the way down to policy changes in the industry. So we have a daily newsletter called the Apartify newsletter. It's completely free. If you're not subscribed to the newsletter, you can go to apartify.co/news and you can get into the newsletter. This newsletter, you'll get all of these articles delivered straight to your inbox every single day. And once you get the articles delivered to your inbox every single day, you can go and read it, and then you can come on the show and listen to my take on these newsletter articles. So I'm feeling kind of good today. We switched the mics up a little bit. That's really good. I have my vest on, which makes me feel really feel really good. And we're going to dive right in. So as always, if you want to see any of these articles, get on the newsletter, apartify.co/news, and you can see any of the articles. The newsletter is 100% free. So first headline reads, Arbor Realty Trust works with borrowers facing rising interest rates. So it reads, navigating the world of real estate can be tricky, especially with rising interest rates squeezing borrowers. Today's newsletter highlights a recent move by Arbor Realty Trust, a real estate investment trust that focuses on lending to real estate investors. So helping hands, Arbor offers loan relief. Arbor Realty Trust is recognizing the challenges some borrowers are facing due to rising interest rates. To prevent loan defaults, the company has provided workouts on a staggering $1.9 billion worth of loans. These workouts involve measures like extending loan terms, which is providing borrowers with more time to repay their loans by pushing back maturity dates, and then temporary rate relief, which is offering reductions on interest rates to ease the immediate financial burden. So it's not all one-sided. Borrowers step up too. Slow down, my boy. So while Arbor is offering a helping hand, it's not a complete handout. In exchange for the loan modifications, some borrowers have agreed to increase principal payments. This helps to ensure the loan gets paid back faster despite the extended term. And they've also agreed to boost cash reserves. This strengthens the borrower's financial position and provides a buffer against future fluctuations. So, Arbor's take is a win-win approach. Arbor Realty Trust emphasizes these loan workouts. Arbor's take is a win-win approach. Arbor Realty Trust emphasizes that these loan workouts are designated to improve the overall position of each loan by working collectively or collaboratively with borrowers. They can mitigate the risk of defaults while ensuring long-term health on their loan portfolio. So, basically, Arbor Realty Trust has been doing loan workouts in-house and being proactive about the situation. Now, I think this is really good, and I made a post about this on my Instagram page, which if you're not following me, you can go and follow me, Roderick Jones on Instagram, or you can follow me on LinkedIn, Roderick Jones. So, I made a post about this on my Instagram page, which basically said that smart multifamily sponsors are going to be proactive. So they aren't reactive. They aren't going to say, well, my loan is coming due, I'm not going to do anything. They're going to try to work something out with the lender. And most of the time, lenders just want the deal to perform. So if you can continue making the payments, then you're going to come up with a deal with the lender and you're going to be able to modify your loan. So when everybody was talking about you have 1.9 billion or 1.9 trillion or whatever the number was of bridge loans coming due, that is true. They may have been coming due. However, most lenders don't want to take that L. So what they're going to try to do is just do a loan modification. And if you're a smart borrower, if you're a smart multifamily operator, you would try to do a loan modification as well. So this article just supports what I've been saying the whole time. Most people are going to do these workouts. They're going to be proactive instead of reactive. And we may not see that whatever trillion dollars of multifamily debt come due. We may not see that come due because everybody's sophisticated here. They can see the writing on the wall, and they're going to try to make sure that that doesn't happen. So that is good. If you want to see that article, you can go to apartify.co/news, get on the newsletter, and you can see this article. Let's move over to article number 2. So article number 2 reads, higher deductibles ahead. HUD raises the wind and storm coverage limits. So if you don't know what HUD is, we'll explain in this article. So attention multifamily investors with FHA insured mortgage. Slow down, my guy. So attention multifamily investors with FHA insured mortgages in hurricane prone areas. The Department of Housing and Urban Development, which is HUD, just announced a significant change to wind and storm coverage. Brace yourselves. Higher maximum deductibles. No. So effective immediately, HUD has increased the maximum permissible wind and storm deductible for FHA insured properties. Here's the breakdown. So here's the new deductible. The maximum deductible is now the greater of $50,000 or 5% of the insured value per location, up to a maximum of $475,000 per occurrence. And then this is up from basically $50,000 or 1%, or it was capped at $250,000. So they removed the cap and they took it up to $475,000. So this change means that in the event of a covered storm event, property owners could be responsible for a significantly higher initial out-of-pocket expense before insurance kicks in. So according to HUD, this move aims to increase availability. According to HUD, this move aims to increase availability of coverage and maintain affordability. So what this means for you, reassess your risk management. This change highlights the importance of carefully evaluating your wind and storm coverage needs. Here's what you consider. Review your coverage, explore additional options, talk to your insurance broker. So, HUD increased the deductible from $50,000 or 5%. No, from $50,000 or 1% to $50,000 or 5%. And then they also increased so they increased the deductible. On this, I don't really know much about insurance, so I really can't speak on how insurance works. I just know that you need it for your properties, and it is something that is hit or miss in the industry. So I think this is going to be standard across the field. A lot of sponsors have already been talking about how insurance costs have been raising or has been going up in the past couple of years. It's only right that HUD increases as well. So I think this is spot on. And also inflation has been a big thing. So everything with inflation, the price of everything has been increasing. So I think it's only right that HUD increases the prices as well. So I don't really know much about insurance, but that's what I know about that. So let's move over to our third and final headline. Again, if you want to see any of these headlines, go to apartify.co/news and you can see the headlines too. So let's move over to our third and final headline. Multifamily loan delinquencies are on the rise. So you remember that first headline where we were talking about Arbor Realty Trust working out $1.9 billion worth of loans. They were proactive. Now the delinquencies are on the rise, and let's see what this article has to say. Today's newsletter dives into concerning news for multifamily investors. According to a report by JP Morgan Chase, multifamily lenders are increasingly buying back delinquent loans. This trend indicates potential trouble brewing in the multifamily market. Delinquencies surge. Lenders take back bad loans. The report reveals that multifamily lenders repurchased a whopping $520 million worth of delinquent collateralized loan obligations, CLO, credit in the first quarter of 2024. This represents a 210% increase compared to the same period last year. So why the buybacks? There are a couple of reasons why lenders might be aggressively buying back these bad loans. Number one is maintaining CLO health. Lenders might be concerned about their overall health of their CLOs. By repurchasing delinquent loans, they can prevent them from further dragging down the value of their entire CLO, which is their collateralized loan obligations. And then secondly, they're managing risk. Taking back control of these loans allows lenders to potentially renegotiate repayment terms or even foreclose on the properties. So, what does this mean for you? The surge in loan buybacks suggests that some multifamily borrowers are struggling to meet their financial obligations. Here's why you should be aware of this trend. Increased scrutiny by lenders. Lenders might become more cautious when underwriting new multifamily loans, potentially making it harder to secure financing. And then this is also a potential for a market downturn. A rise in delinquencies could indicate a broader financial stress within the multifamily sector. So, what does this news emphasize? This news emphasizes the importance of careful due diligence when considering any multifamily investing. Here are some tips. Thoroughly research the borrowers. Focus on strong fundamentals and diversify your portfolio. So what do I have on this? I've been saying this for years. So I've been saying that multifamily is very hot and it's almost time for a cool down. And I started calling lenders or calling banks back in 2020. And a lot of them were laughing me off the phone saying, hey, call me back when the next recession is here. We don't have anything. We're looking really strong now. And so now with these rising delinquencies, this is starting to bring some concerns to the lenders. And like I said in the first post, a lot of them are trying to be proactive, meaning that if they have the resources to purchase these CLOs or to buy back these loans, they will do it. And when they do it, or when they start buying these loans back, that gives them, that lowers their risk. They're able to manage their overall health of their CLOs and things like that. But I also think that we're going to start seeing more delinquencies in the market. This is only up 210%, and this is the beginning. We're not nowhere near close to the end. We're not even in the middle. This is the beginning. We're going to start seeing more loans, defaults come. We're going to see a lot more loan defaults. And then this is going to create an opportunity for the banks to either be proactive and try to buy them back, or this is going to create an opportunity for the savvy investors to go in and buy these loans at a steep discount, or not even a steep discount, but at some type of discount, and then build their portfolio that way. So I think we're going to start seeing a lot more delinquencies. I think this is just the first of many. And I think either banks need to start being strategic and proactive, and then they can mitigate the risk. But the banks that are not proactive and they're reactive, they're going to drag this out. Once it gets to a point where it's, unbearable for them, they're going to need to sell it at a discount. Once they start selling at a discount, that's going to drop some prices down, and the savvy investors can buy these things for pennies on the dollar. So that is it for today. Let me know what you think on any of these three articles in the comments. Drop your answers in the comments. What do you think on these topics? What topics do you want me to review next? Leave your suggestions in the comments. If you got anything from the show, make sure you leave a like, make sure you review, and make sure you share it with somebody. Let them know that you listen to the Partify Daily, which is the podcast where we make you smarter on multifamily investing. With that being said, I'll see you on the next one.